Thanks very much. And hello, everyone. Thank you for coming to this panel. We are here to talk about challenger banks. I've got a very esteemed panel. We've only got about 20 minutes, so I will get straight into it and introduce the panel. So from the far end, we've got Cordelia Kafetz, Director of Financial Risk at Starling Bank, Conrad Ford, Chief Product and Strategy Officer at Allica Bank, and Valentina, Kristensen, Corporate Affairs Director at OakNorth. So jumping directly into it, you're all challenger banks. The Bank of England has a competition mandate that's designed to kind of help you grow, help you compete with the larger banks. Is it doing its job? Shall we start from the end?
Yeah, sure, thanks. I think what I would say is not quite yet. In some ways, what the PRA has done in lowering barriers to entry and getting its competition mandate 10 years ago is that 40 new banks has entered the UK market, and that is actually a lot, right? Before that, there was one new bank in 100 years. And so from that perspective, they've made a lot of progress. And actually, I think, the entrance of some of the challenger banks has made the big banks up their game. I'm not sure that their apps would be as good as they are today. I don't think the user experience would be as good as they were today had they not had the challenger banks competing with them. So I think in terms of kind of startup, like the Bank of England and their competition mandate, they've done a lot, and they really have reformed the regulation for banks in the first 5 years. What's next, though, I think, is looking at how banks can go from that startup phase to scale up to systemic. And that's where I would say not yet, because no bank has got big enough to truly compete with the large firms. It kind of goes back to what the Economic Secretary was saying yesterday. Do we just want to be a culture of encouraging startups in the UK, or do we want to take these firms further? And I think that's kind of what still needs to be achieved.
Yeah, and that's perhaps quite a shocking piece of information. We've got obviously a lot of successful challenger banks, but none of them are matching the big banks. So, Conrad, do you think something's gone wrong?
Yeah, I want to just really endorse what Cordelia just said. I mean, our regulator should have huge credit for the number of banks that have been allowed into the market, compared to Australia, for example, which post the global financial crisis was in a very similar situation of having a small number of dominant banks. We have issued far more banking licenses than they have, and I think that's a real positive. But there has it feels like there's a barrier to scaling. And if you look at SME lending, for example, SME lending, more than half of SME lending is now done by specialists and challenger banks. So these, generations of new banks that have entered the market after the global financial crisis. So on the one hand, you can say that's a huge success, but the reality is our SME lending market is very small by international standards. So in other words, the big banks in the UK really don't have much enthusiasm. So if they're not going to be lending to our SME population, to the real economy, then somebody else has got to do it, and you've got to really unshackle and allow the challenger banks to scale up. And I think that's the missing piece, or the next piece of the puzzle that needs to be solved, which is how do you create an environment for scale-up banks? And I'd make an observation about the kind of historic banking model we've had in this country. We have big universal banks. And the problem with universal banks is they do all things, all aspects of the value chain. They do every single customer from students through to Vodafone. And the reality is they're jack of all trades and master of none. So you end up with underserved pockets because they will not focus on small niches. And some of those niches, like SMEs, are massively important to our economy. So that's the bit that needs to be solved.
Yeah, thank you. So we've heard kind of barriers to growth. Would you agree with that, Valentina, and what needs to be done about it?
I mean, absolutely, and we've talked about both. I mean, yesterday I was in the roundtable with the EST for the Unicorn Council, and sort of talking about the different barriers that scaling banks specifically, and scaling fintechs face, and it's both from a fiscal and a regulatory perspective, right? We've heard about MREL and Basel III, and I think and corporation tax surcharge, and this is exactly the point, right? That and BIM sort of said. But you have to stop thinking of yourselves as the underdogs, because you're not the underdogs anymore. And while I can appreciate that, I think, within the UK banking market, you've kind of got these three buckets, right? You've got the very, very new small banks, and they've been granted licenses in the last few years. Then you've got where the OakNorth, the Starlings, the Monzos, and Allicas would sort of sit, the mid-tier and specialist banks. And then you've got the large systemic players. And the reality is that the sort of 40 or so banks that fall into the mid-tier specialist area, we have about 25% market share between us. So I suppose it's how you look at the measure of competition? Is it, the new bank startup unit have granted, over 3 dozen new licenses in the last 14 years or so. So in that regard, absolutely, they've done a huge amount and certainly a lot more than you could say in other countries. But it's then that point of, as a bank, we sort of face a bit of a cliff edge with a lot of the regulation, right? And it is a bit absurd that you can have a bank that's got 4 billion of assets having to meet a lot of the same regulatory requirements as a bank with 400 billion of assets, right? I mean, there's a mismatch there, and it's almost like you need, you've got the new bank startup unit, you need a sort of scale-up unit, within the regulators so that they can work with some of the banks, the mid-tier banks that have reached a certain scale, whether it's in terms of customer numbers or in terms of assets, as is the case with OakNorth.
Right. And the challenger banks are sometimes, well, the mid-tier challenger banks can be described as the squeezed middle. So, you're too big to enjoy a lack of tough regulation, but you're not quite big enough to, be able to scale in the same way that
I would say regulation is always tough. I mean, having gone through the process of getting a banking license, it's very tough, and it should be. But I would also say, there's banks. We have allowed the smaller banks to fail, right? I mean, I think Bank North was a bank that got its license and sort of closed up shop a couple of years ago or last year. But it's sort of then. There's a lot of regulation that's in place that's sort of not really fit for purpose. It's not proportionate, right? We have to, again, as I say, we don't have an entire floor in Canary Wharf of risk and compliance people, as some of the large banks will have. Our risk and compliance team is like 10 people. So, it's a really big burden for us to have to kind of tick a lot of the boxes that just, as I say, just wouldn't necessarily, they're not really fit for purpose or right-sized for a bank of our size, which is not systemically important. And a lot of the regulation was written post-financial crisis, like the corporation tax surcharge, right? I mean, we have to pay additional tax on, I know no one's going to have any sympathy for a bank paying additional tax. I totally appreciate that. But, we have to pay additional tax on profits over 100 million. We made 187 million pre-tax profit last year. So, if I think about we're a bank that doesn't pay dividends, so any money that we make goes back into our business, goes back into lending to SMEs. So it seems sort of one step forward, 2 steps back with some of the regulation and some of the sort of fiscal penalties that we have to face. Yeah.
Well, let's talk regulation because of the aptly named panel. It's going to be a Reg-olution. Is it going to be a Reg-olution? Let's start with you, Cordelia, and let's talk Basel 3.1. What are your thoughts? We're still kind of waiting for very final policy from the Bank of England, but how do you see it affecting your firm and the challenger bank entities generally?
I think this goes back to your point on the squeeze middle. The regulator has done a lot to encourage new banks, like we were saying, and they've recently come out with their small domestic deposit taker regime, the SDDT regime, and that is for banks with assets of 20 billion and below. But then between 20 billion and 50 billion, 100 billion, 200 billion, etc., banks are subject to the same regulations, and in fact, I think there is a competitive disadvantage for that mid-tier. And what Basel 3.1 does, to some extent, what Basel 3.1 does, is that better? To some extent, is to look to reduce some of that, right? So just without trying to get too technical, a lot of the large banks have their own internal models to calculate their capital requirements. And the newer challengers can't use those internal models yet. They just haven't been around for long enough. And the larger banks have much lower capital requirements for a number of asset classes. And Basel 3.1 seeks to close that gap, but not enough. By the end of the Basel 3.1 transition, firms with internal models will still hold, for some asset classes, 25% less capital than the mid-tiers. And the mid-tiers, once they grow beyond that 20 billion, won't be subject to the small domestic deposit taker regime. So it looks to close that gap, but it doesn't do enough. And actually, in the transition to Basel 3.1, the firms with internal models have 4.5 years to transition. Firms on the standardized approach don't have any time to transition. Their requirements come in completely on day one, so that competitive disadvantage gets bigger for a couple of years. So what with Basel 3.1, a lot of the mid-tiers have to hold, again, without trying to get too techie, but additional forms of debt called MREL for resolution purposes. In the EU, firms don't need to hold that type of capital until they get to 100 billion euros of assets. In the UK, it's 15 billion of assets, or even smaller if you've got current accounts. So that's kind of another area where the mid-tiers get squeezed. And then more broadly, beyond MREL and Basel 3.1, there are 53 thresholds for when regulation kicks in for banks. 53 different thresholds, and that is a complex regulatory regime for whatever size that you are. And so I think kind of, having some kind of review looking at the implication for capital requirements for the mid-tiers of MREL, of these 53 thresholds holistically across all of the regime, not to give mid-tiers an advantage, but actually just to reduce the disadvantage that's currently inherent within the system, would be really beneficial.
Yeah, do you feel that's something that the Bank of England, the PRA, are kind of listening to at the moment?
I think it's timing. It takes a long time to make policy at the moment, particularly in the post-Brexit world, where the PRA are having to develop all of the policies themselves, and they're not kind of part of the European policy machine. And they are bringing in the strong and simple regime for the smaller firms. They have said they will do something on the mid-tiers, but it's a question of when. And before we need that now, and we need the regime to be looked at holistically now. I mean, in fact, we probably needed it 2 years ago. So I think potentially, but it's a question of timing.
Yeah. Conrad, do you see there being a competitive disadvantage with the new regulation coming in?
Well, as you mentioned, we're about to find out. So for those that don't know, we are about to get the final rules on Basel 3.1. So Basel 3 was the enough is enough capital regulations that were set globally after the global financial crisis. So setting a new bar in terms of the amount of capital that banks need to hold. And a very important and successful piece of regulation, I think. So Basel 3.1, and the Americans call it the cooler Basel Endgame, is the final set of rules. So in other words, finishing the job after the global financial crisis. So here in the UK, the Basel regulations, Basel 3.1 regulations is hundreds of pages of policy, because we're lucky to have arguably the greatest financial centre in the world. So we have pretty much every single type of asset and liability you might want to hold capital against, we have it here. But if you look at there's something like £7 trillion or thereabouts of assets that are looked at by our regulator, within most of which is within the square mile we're in right now. $250 billion of that, so about 4%, is lending to SMEs in the UK, so domestic lending to SMEs. So a tiny, tiny proportion of this entire balance sheet that the regulator looks after. But that 4%, or that $250 billion, it underpins half the economy and more than half of jobs and more than half of tax base of the country. So in other words, it's kind of like, if the 7 trillion is a wall, this one brick, if that brick gets weak, the whole wall comes down. So I would make the observation in the first set of consultation that we saw around Basel 3.1, some of the rules around SME lending, we commissioned independent research actually, and it said that about £44 billion of lending would be taken out of the market as a result of that. So that's almost 20% of our SME lending, and our SME lending is already low by global standards in this country. So taking away that investment capacity in our economy would be very dangerous. I think the concern that I would have is, because we are a major global financial centre, does our regulator have enough resources to focus on the real economy, that kind of SME base? Because if you compare our Basel 3.1 with continental Europe, for example, most of the central banks in continental Europe looked at the impact on the SME population of their capital regulations. They did detailed research. We don't seem to have had that detailed research here. So I would be really keen that the regulator interprets its competition mandates as a real desire and need to actually look at the impact on the real economy, because it's the real economy is the source of the financial power that allows us to have the City of London. So we're about to find out, basically, because the final set of guidance around Basel 3.1 in this area is actually coming out, I think, this quarter. So we will find out very soon, and I'm very hopeful that the regulators listen.
SME lending is I think probably the biggest topic that's come out of Basel 3.1 from banks anyway. They've been very vocal about the fact that the removal of the SME supporting factor could just, completely affect lending to small businesses in the country. And I think, if you look at the discourse around this, the government is kind of, siding with the banks in a way and saying that it's very important that we keep lending to SMEs, and these rules may affect that. But, ultimately, it's in the PRA's gift to decide what to do. Valentina, what do you think about that? On the one hand, what do you think about the fact that lending to SMEs could change, but also the fact that it is just entirely up to the PRA what to do on that front?
Well, I think it goes back to this sort of like one step forward, two steps back. There's a lot of regulation that's designed to help players, like ourselves, like Allica, like Starling, to do more to help support SMEs. But then you equally, have on the other hand a lot of regulation, or fiscal penalties that then make it that much harder. As I say, and I gave the corporation tax surcharge as an example. We don't pay dividends, so any money we make is going back into our business and to lending to SMEs. And when you've got, as I say, between the sort of 40 or so mid-tier banks, we still only account for 25% of total SME lending. So I think the fact is, you've got, the largest chunk, 75%, being with, the big five. So I can totally appreciate there's priorities in terms of where they need to focus their attention and where the regulators need to focus their attention. But I do think absolutely it would impact lending to SMEs, and I do think it kind of goes back to the first point, which is and the point that was made by the minister yesterday. If we want the UK to be competitive on a global scale, and if we don't want this to just be a nice place for startups, then we do need to support those those institutions that are scaling. And one of the things that came up yesterday in the roundtable was sort of a need for more knowledge about what it's like to be operating in one of the scaling banks, and whether you could almost do secondments and kind of get regulators into some of these mid-tier banks, spend a bit of time and understand how they operate and some of the challenges they're facing, so that you can then take that back and sort of build that institutional knowledge with the regulators. We obviously see secondments in the large banks all the time, so there's potentially an opportunity to do that. It's just whether the banks would be happy to open their doors and let the regulators come in for a few months, and I'm sure they would be. I think we'd certainly be open to the idea at OakNorth.
Cordelia, would you let the regulators through your doors?
I think that's a really good point, actually, because, I am an ex-regulator. I was at the PRA and Bank of England for a lot of my career, and I think, actually now, having worked for over 3 years at Starling, if I went back into the policy arena now, I would be a much better policymaker, like understanding day-to-day what it is like for firms trying to navigate the PRA rules, trying to navigate the regulatory environment, and seeing, to Conrad's point, there's kind of much more tangibly the real-world impacts of some of the regulations that we face. And it's not to say that we should lower the standard. I'm a big believer that regulation of the financial sector is really important, but it's how they're implemented. And I think, back to Conrad's point on the real economy, it's not really clear what the regulators want to achieve with their competition objective. Competition itself isn't kind of an end. It's like a means to an end. Is it about reducing the amount of deposits held in the big five, reducing their market share? Is it about reducing their market share of residential mortgages or SME lending? Is it about enabling more consumer choice? Is it about tightening prices actually to create a more competitive market? And I think if they're clear on the objectives they want to get to with that endpoint, it will then be much easier for them to measure their success, for us to all be able to answer the question of have they been successful in their competition mandate, for their competition report that they put in their annual accounts to be less descriptive. It's very descriptive now, and this is what we've done, but not have we achieved the outcomes we want to achieve. And also enable policy to be much more tightly focused on achieving whatever the outcomes they want to achieve through enhancing competition in the UK banking market. And it's beyond banks as well. There's non-banks providing competition to banks. Where does a central bank digital currency will provide some kind of competition to current account business models? So what's that kind of overall vision on how they want the financial sector to look like around deposits and lending, and where do banks fit within that? And I think, getting the regulators to understand more about the challenges that these firms face, back to the secondment point, will be really helpful in them thinking about that kind of broader vision.
Conrad, in addition to secondments, are there any ideas that you have to kind of help regulators understand the specific challenges of challenger banks?
Well, I mean, I'd like to just really agree with what Cordelia said there, actually, which is that, you know, we would be expected and we would expect ourselves to set numerical objectives and milestones in terms of what we're trying to achieve. So the competition objectives, I don't think they're talked about enough. At the moment, they're talked about in terms of making the city competitive on the global stage, which is super important. But if you read the competition objectives, it's a lot more than that. But you know, a lot of politicians, that's all they talk about, right? And it's important, but it's much wider than that. I would love to actually see a bit of you know, substance in terms of, you know, the future we are trying to create is one where we don't have banks that are too big to fail. We don't have underserved niches because we have allowed these things to happen. And you know, one example you just gave there is the deposit base, you know, consolidation of the deposit base in the big players. So I think that would be a really good step, and it would be a brave step. But in the end, you know, bravery is a good thing if you want to succeed.
Great. So we've got a couple of minutes left, so I'd like to just go to each of you and ask kind of what your wish list would be from the regulators. You know, we've spoken regulation, we've spoken the specific challenges for challenger banks, the competition mandate that regulators have. But, you know, if you had kind of one thing that you think the regulators really need to listen to, what would it be? Should we start with you, Valentina?
God, I mean, one thing, that's really hard. I would just... Look, I would say it's under the broad umbrella of capital requirements. You know, more proportionality in capital requirements would make a huge difference, not just to us in terms of scaling our own business, but in terms of the capital we'd have available to support the SMEs that we've come to market to support.
Conrad.
I would love the regulator to bring forward the scaling up banks point. You know, we talked about it at the start, but it's a super important point. The regulator has done a brilliant job of allowing startup banks. It now needs to do a brilliant job of allowing banks to scale up. So bringing forward that bit of policy agenda, because there's so many spin-off benefits. You know, niches would be better served. The big banks would be forced to raise their game, you know, just as Monzo and Starling have forced them to raise their game in apps, for example. So there's so many spin-off benefits, and it kind of feels like our banking market, our startup banking market's at a tipping point. It's either going to become transformational in a positive way, or it will kind of like reach an evolutionary point where it can't grow. Now's the time.
Yeah, and I would build on that and take it one step further and to say, you know, commission a review of what are the barriers for firms going from scale up to systemic. We've mentioned some of them today, but it won't be all of them. You know, why are firms needing to consolidate with each other, as we've seen in the market recently, to go from mid-tier to systemic? Why does that need to happen, and what are the barriers? And holistically across, you know, not just looking at capital individually to liquidity to remuneration, looking holistically across those 53 thresholds to say, what is it that is preventing firms from going from scale up to systemic, and coming up with that review, coming up with recommendations for the regulators to implement.
Great. Well, those are some excellent points. We've had a whistle-stop tour of how regulation affects the challenger banks, and I think we've all got some great takeaways. So all that's left for me to do is to say thank you to my panellists and thank you to everyone for coming to listen.